Hi, I'm Daryl Jones, the Director of Research at Hedgeye Risk Management. Welcome to our studio in Stamford, Connecticut. I'm joined by my colleague Hisham Shaban. We spent the last 3 weeks working on the Twitter IPO. We think it's a really interesting IPO, but it's also getting a little hyped. And with that, Hisham, can you tell us a little bit about the business model?
Yeah, it's a very interesting business model in that it's dynamic, in that all the stakeholders involved attract each other to the site. So as new users join Twitter, it attracts platform partners, which are really content providers, who are looking to gain more reach to these users, and in turn it also attracts advertisers looking to gain exposure to those users as well. Now at the same time, as more platform partners come to the site, it actually attracts more users because the content is richer.
So as I understand it, there are more international users, but there are some headwinds with the overseas market. Could you talk about that a little bit?
Sure. I mean, it comes down to the average revenue generated per user. So in the US, it's about 10 times that of the international market in terms of the revenue that's being generated from these users, because the digital ad spending market is considerably larger in the US on a per capita basis than it is anywhere else.
So the overseas market has been a little underwhelming. What about user growth domestically?
User growth domestically has actually lagged that of the international market despite a much lower user base. So in the US, in terms of monthly active user, Twitter has about 50 million users, and internationally, it's actually more than 3 times that.
So these inactive users, what does that mean for the potential market for, I guess, Twitter in the US in terms of internet usage?
It means that the actual penetration levels are much higher than the monthly average user metric suggests. So if we're speaking only about the monthly active users, then Twitter is about 22% penetrated in the US,
right.
But it could be considerably higher considering the total base of users. Given it could be upwards of 40%. Considering that there are
Yes.
there could be a large number of users that are no longer using
just
the
aren't
sites.
active.
Yeah.
Gotcha. So the most recent news, I guess, that just came out this afternoon was that Goldman has taken up the IPO price to $27. Based on your valuation analysis, what do you do with the stock at $27 or above?
I mean, the first things first, we wouldn't be chasing the IPO. We just think that there's too much risk to the business model given a limited runway for growth, given its current business strategy. I think the best way to approach this is to let the hype settle and then reassess from there.
So our takeaway on the Twitter IPO is, well, on one hand, we like the company, we use it a lot, and you can follow us at Hedgeye on Twitter. Our issues are the valuation, where it's coming at. The market cap will be north of $15 billion, and the multiple to sales on 2014 will be 14 or 15 times. And we just think it's overpriced for what we see as real headwinds to the business model. And with that, thanks for joining us today at the Hedgeye studio in Stamford, Connecticut.